Welcome back for the afternoon session, ladies and gentlemen. We've still got a few stragglers coming in through the door, but we're going to get things kicked off so we're not too far behind schedule. Firstly, thanks again to Zach for chairing this morning's session. We've got a change out of chairman for now this afternoon's session. Adil Harris is going to join us. He'll tell you a little bit about himself, but again, it would be good to welcome Adil to the afternoon for us.
Hi, thank you everyone. So I'll be chairing for the rest of the evening. A quick introduction about myself. My name is Adil Harris. I am a blockchain consultant and product lead at Blockchain Technology Malaysia. We are one of the sponsors for the event. And I'll also be speaking tomorrow at 9 a.m. on Is Blockchain the Right Solution for You? So to kickstart the event, we'll start with the first speaker. We've got a couple of people from Linklaters talking on the topic virtual currencies, new assets in the digital age. So may I please welcome Jonathan Horan and Sophie Mathur from Linklaters.
Good afternoon, everyone. We have the much envied after lunch slot, but we're hoping that there's sufficient interest in token offerings to keep everyone interested. By way of introduction, my name is Sophie Mathur. I am a partner at Linklaters, as well as one of the global co-heads of innovation. And together with my partner, Jonathan Horan, we have been busy helping investors as well as issuers get their heads around the world of token offerings. And we're very happy to share with you some of our learnings and to try and answer that question, what is a token? I'll just let Jonathan introduce himself before we launch into our presentation.
Yeah, thanks, Sophie. So I'm a capital markets lawyer here in Singapore. My day job is actually international sales of shares and bonds. So the first question is going to be, why am I here? Actually, when you start looking at these tokens and the tokens that are securities, the principles that we use every day in terms of security sales and protections actually apply to tokens, and regulators are applying those principles. So some of the things that we're going to run through today are the type of things that we look at in a normal capital markets context, which we think as the market develops are going to guide the way that regulators continue to regulate this market.
Great, so let's kick off. We've got the clicker here. So what are we going to talk to you about today? We're going to talk about what is a token, go through some case studies, give you an overview of the regulatory approach globally, and then finally think about where the future focus of regulatory attention may be. So what is a token? Broadly speaking, we categorize tokens into three categories. There's the currency type, the utility, as well as the security. Now, on the currency type, what I'm talking about there are things like Bitcoin and Ethereum, because that is the closest in crypto world to what we think of as money, accepted unit of exchange. We're not going to be talking about those in today's presentation, because most regulators, or all regulators in the world, don't really see those as securities as such, and so they're not so relevant in the concept of a token offering. Regulators have different concerns about Bitcoin and Ethereum, but that's a separate topic of discussion. So we are going to be talking about utility tokens and security tokens, and what they are and the legal categorization of these tokens. The rubber really hits the road on this in the context of token offerings. Because if you issue a token and you don't realize the category you fall into, you might suddenly find yourself subject to a whole panoply of regulation. So what is a utility token? To illustrate the point, I'm going to talk about the pure utility token, because as you can see, clearly there's a little bit of a spectrum. You might have security on one end and utility on the other, but I'm going to talk about a pure utility token that has no security-like elements. So I like to think of them as airline miles. Very similar to airline miles. You get points, you can use it to access the goods or services of the issuer. And typically, that would be access to a platform is quite often what we see. It doesn't give you any ownership rights. It doesn't give you any rights to the underlying assets of the issuer, and nor do you have any governance rights in respect of the issuer of the token. So where does a utility token derive its value? So in theory, it derives its value from the access to the services being offered. For example, if the token is giving you access to a platform, then if you think the platform is going to be more valuable in the future, then the value of the token will also increase. There may, in theory, also be an intrinsic value in accessing the platform. However, I say in theory because two things. Quite often in the token offerings that we've all seen out in the market, A, the platform doesn't exist, and B, how many of the people buying tokens are doing so to access the platform, and how many of them are buying them in the hope or expectation that the value of the token is going to increase. And this is exactly where there is a difference of opinion between regulators. So in Singapore, the Monetary Authority of Singapore, the MES, takes the view that even if a platform does not yet exist, and people may indeed be acquiring the token for speculative purposes and in the hope of future profit, that in itself does not mean that the token is a security token. They look at the characteristics of the token itself. And this is very clearly stated in the Guide to Digital Currencies that the MES has issued. The SEC, however, takes a very different view. The SEC applies the Howey test. And what the Howey test says is that something is a security or investment contract if there is if someone invests with an expectation of profit derived from the efforts of others. Now, the head of the Division of Corporate Finance or Corporation Finance at the SEC spoke at a cryptocurrency fairly recently, just earlier this month. And I'm going to quote liberally from his comments because I think they're very instructive and give an insight into where the SEC is on this point right now. And what he said is that in a typical token offering, this is exactly what is happening. The investors are passive, and they are reliant on the efforts of the promoter to make the enterprise a success. And this is particularly the case where the platform is not operational, which, as I said, is often the case in what we're seeing right now. And I'm quoting from his speech now, where he says, at that stage, the purchase of a token looks a lot like a bet on the success of the enterprise and not the purchase of something used to exchange for goods and services on the network. It's worthwhile noting, though, that even where the platform is up, the SEC has been unconvinced by the concept of a utility argument. They've said that everything they've seen, in fact, has been a security. And the SEC shut down an ICO by Munchie, which some of you may have heard of, where the platform was up, and there was a restaurant review app that had offered tokens for use within its app. So there was some utility in that, and that you could use it for the app, but the SEC found that such tokens were securities, were investment contracts, and in coming to that conclusion, they pointed to statements made by representatives of Munchie during the marketing of the offering, where they were outlining how investors stood to earn profits on their initial investment. Now, let me translate that, because stood to earn profits is lawyer speak for the "you are sure to make money!" exclamation mark, exclamation mark, exclamation mark, that was in the tone, that was the tone of the marketing material for the Munchie ICO. So to sum up, in relation to the utility tokens, there are jurisdictions like Singapore that do recognize them and see them as assets that are not securities and are not subject to securities regulation. But the SEC, for all practical purposes, do not see things that way. The practical ramifications of this is that we have advised token issuers to exclude the US and US persons from the offering. And this is very similar to what you do in traditional capital markets, picking up on John's point that there are lots of analogies and practice points to be drawn from how we've always operated in the traditional capital markets. Of course, you may issue in the US, but it just means there's an increased cost of compliance in doing so. So as a utility token, what rights do you have against the issuer? In short, not many. The way the disclosures are usually drafted in the disclosure package, it basically says that if the issuer builds the platform, then the token will give you access to that platform. Going back to my airline analogy, if I build an airline, then you can use the points for a flight. And it is in the more reputable issuers, it is a very clear risk factor, and they set out that there is a risk that the platform may not ever be built. Now, this, of course, assumes that the issuer is acting in good faith, and despite its good faith efforts, the platform is not built. If we are in the territory where the issuer has no intention to build, and it is a scam, and we heard, I think, earlier today that sadly, a very high proportion of these things can be scams. And if you're in that scam territory, then you're not in securities regulation anymore. You're in the territory of fraud, and the police can get involved, and that's where you can have a criminal claim against an issuer for fraud. Now, if the token, now moving on to security tokens, if the token being issued gives an interest in the issuer's profit, underlying assets, or gives governance rights, then the regulators will look at that as a security. This is a rule of thumb across the different regulators globally, and the fact that the token is in digital form is neither here nor there. The fact that you don't appear on the issuer's cap table is also neither here nor there. The token will be treated as a security and be regulated as such. And this is also very clear in the MAS paper on digital offerings that I referred to earlier. And although a token is treated like a security, it's important to remember that it is not technically a share in the company. And I alluded to this earlier when I said you're not going to appear on the cap table. You only have the contractual rights that the token has given you in respect of whatever it is it's given you. But what you would have as a holder of a contractual right is a claim against the company under contract. Because as far as I'm aware, the only jurisdiction in the world that has issued truly digital securities is Delaware. And in that situation, you do actually have a share, and that's a digital security. Everywhere else, it's not a share. It's a contractual right. So now that we've discussed the features of utility tokens and security tokens, John is going to take you through a couple of case studies on matters that we've advised on to give you some real-life examples. John?
Thank you. Okay, thanks, Sophie. So now we're looking at two live examples that we've worked on in the last 12 months. They're at each end of that spectrum which Sophie's been talking about. The first one, there is Zilliqa. Some of you might have heard of that. It's a Singapore-based startup. They issued tokens in January of this year. They are essentially a public blockchain. They're focused on scalability and speed, so solving some of the problems that we were talking about this morning. Importantly, they were an entirely public platform, so that the token itself conferred no rights other than access to the platform. There was no equity rights, which Sophie was talking about, and no rights to profits. So that clearly gets to the utility end of the spectrum. The reason we worked with these guys, they were very cautious. They wanted to make sure this was done absolutely correctly. They wanted to engage the MAS. So part of our job was actually writing the analysis around this token, engaging with the MAS, a number of discussions and back and forth to get to a position with the MAS where to agree that this was not a security under Singapore law. And importantly, I think sometimes people just focus on just that question around security. There's a secondary question which is around licensing. If you are, as a founder of a startup looking to raise money, are there licensing issues too? Are you out promoting a security, promoting fundraising? It's not just this basic question of are you a security? If to do this stuff properly, there are other issues around making sure that you are clear in your home jurisdiction. So where we got to with Zilliqa was that it was unregulated and not a security, which actually from a lawyer's point of view ends up being quite an unusual situation. Because we can then go and sell this token, which is no question high risk, no guarantees of reward, and we could sell that to anyone in Singapore. We could advertise any way we want, we could sell it to anyone, and we essentially had an agreement, opinions from us saying that was the position. As Sophie also alluded to, what's really important about this stuff is it's not just about the home jurisdiction. It's actually about everywhere that you want to sell that token. So while we were clear in Singapore, it was still going to be, there's a risk that it was a security in the UK and the US for different reasons. And so we had to control that ability to sale. So when you launch off your digital platform, off your website, you have to control which issuers are able to access the fundraising. So while we knew Singapore was clear, Hong Kong was clear, we were not able to actually offer the tokens to the UK and the US in particular. These guys ended up getting quite a lot of demand through the private process, so the pre-sale process, and so we didn't even need to get to the public stage, even though we had set up to go public. And again, from a risk point of view, that's a great place to be. So we had maybe only 100 investors through the pre-sale. We had direct contracts with them through a subscription agreement, which controlled the risk significantly for the issuer, for Zilliqa. We didn't need to go out publicly where all the type of public capital market securities laws issues that we'll get onto later. So that's an interesting one at the utility end, and again, I think the MAS was very engaged and supportive in helping that issuer come to market. At the other end of the spectrum, a deal that we're working on at the moment is a digital securities platform. They are intending to raise crypto, so Ether and Bitcoin. They will pull those funds and invest in a physical asset, which will produce regular income. The profits that are produced will then be issued through the tokens back through Ethereum back to these token holders. This one, no question, it's a security. Every jurisdiction you look at it, it's going to be a security. What does that mean? That immediately then starts looking like what we do in a professional, institutional capital markets raising. So you can't sell it to retail. You have to control who you can sell it to. You need to control the messaging around what your social media says, what your website says. You definitely don't want to go into the US unless you've got very specific rules around accredited investors and lockups. So it gets very complicated now trying to sell anything into the US. Even for somewhere like the UK, who they were keen to sell into, very strict verification processes. So actually not just getting a tick the box, I'm a professional, but actually making sure that you're actually forcing the investor to download or to upload their verification, net wealth, other things to verify that those individuals under that English law can actually access the tokens. The really interesting part about this last one, they've actually been building this platform for nearly 12 months. A lot of the technology behind it we find very interesting. The last point here about the KYC verification. For these guys, again, they wanted to set a real benchmark for the market, and so they're very focused on secondary trading. They want to make sure they know every individual that holds their token. So once we've done the ICO, once the tokens have been issued, in order to buy that token in the secondary, you'll need to go to their website and actually pass KYC before you can actually go and buy that token. So you're on a whitelist, and there's a number of issuers that are starting to look at this issue. Now, I'm sure a lot of people are thinking, that's a hell of a lot of hard work, why do I want to buy that token? This is really just testing out what we can do and how we can comply with some of these regulations. But actually, the smart contract behind the token, when you try and transfer between A and B, it will go and check the whitelist automatically. And if investor B is clear on the whitelist, that trade will go through. If they haven't been verified, if they're not on the whitelist, the trade doesn't happen. So the fact that can all happen automatically behind the scenes is really interesting technology. Comparing it to the traditional world, it's obviously not something that we can do. You're going to need some type of intermediary there to be able to actually check and verify the individuals. So I think, as we said earlier, I think the important thing here is that all tokens are different, they are unique, and that provides great business opportunity because you can actually think about what your terms want to be. But from the legal point of view, that actually clearly creates legal uncertainty, and that's why I think we're in this situation where regulators are really trying to struggle to catch up to what these are and how to treat them. I think the important point, again, to do this properly, and we're not suggesting that everyone needs to do it properly. There are a whole bunch of issuers that are just going to take the regulatory risk and issue their tokens. But for those that want to do it properly, it really means a deep analysis of what that token is, where it sits on the spectrum, and importantly, the home and the selling jurisdiction. So thinking about it from two angles. So with that, I'll hand back to Sophie for a quick review of what the major regulators have, the way they've approached things.
Thanks, John. As we've said a couple of times already, you need to think about the home jurisdiction as well as the jurisdiction in which you are going to offer your token. And again, that's very similar as what you would do in the context of a traditional capital markets offering. the risk is heightened for a token offering because in a token offering, by definition, it's borderless. And so the risk of someone in a jurisdiction that might take a different view to tokens, that risk is absolutely there. So what I propose to do in the next few minutes is to give you a 20,000 feet view of the different approaches that regulators have taken in respect of cryptocurrency and token offerings. As you can see on the slide, we're going to put certain jurisdictions on a spectrum. And China would be on one end of the spectrum, given that they have banned ICOs and they have also banned trading in crypto. Mining, as far as I'm aware, they don't like it, but it's still happening. Korea has also banned ICOs, and they announced earlier that they were thinking about banning trading in cryptocurrency, but to date, that ban has not yet been imposed. Now, we talked about the US earlier. The reason that they are on the side of the spectrum that they are is that the fact that they don't recognize utility tokens in practice makes it quite hard to offer tokens in the US. Possible, but the cost of regulatory compliance is going to be very significant. And as we've seen, the SEC has been pretty strict about enforcement in the US, so this is something that is very clearly on the radar. We've grouped Japan, Hong Kong, and Singapore all in the same bucket in respect of their overall approach to crypto and token offerings. These are all countries where the regulators are taking what we would describe as a middle-of-the-road approach, acknowledging the reality that crypto-related activity is here, it's here to stay, and there's probably only one direction that it's going to go, and constructively engaging to help regulate the markets. And just a point here on constructive engagement. Since I started talking to people about crypto, which was a couple of years ago, the position that we've espoused is always that we are welcoming of regulation. Not in a way that is restrictive, but in a way that is constructive, because clarity is good for the market, and it's best to have some measured, appropriate regulation before there's a crisis of some kind that could then create a knee-jerk reaction and then close things down, potentially once the horse has bolted. So I think that when we talk about this middle-of-the-road countries, at least in our experience where we are dealing with the regulator here, they have indeed been taking a constructive approach. And I talked about the guide that they have issued. And we are also aware that they are proactively seeking and have sought industry feedback on their approach. At the same time, however, they have taken steps to enforce. So earlier this year, you are probably aware, the MAS warned 8 digital token exchanges in Singapore not to facilitate trading in digital tokens that are securities or futures contracts without the MAS's authorization. And it also warned an issuer to stop the offering of its digital tokens in Singapore. And the issuer was also made to return the funds to all the Singapore-based investors. Now, the Japanese regulator has been focusing on the regulation of cryptocurrency exchanges, and they recently announced rules in relation to this. Now, those rules, we are guessing, are a reaction to the hacking of CoinCheck, one of the largest crypto exchanges in Japan, where there was a hacking incident and approximately $500 million of crypto was lost. And moving on now to the other side of the spectrum, the UK, it does recognize the concept of a utility token, but the challenge with the UK, and John alluded to this earlier, is that because the EU regulations are relevant in the UK, and there are a whole host of EU directives that may be relevant in the context of an offering that you make available in the UK, that it is quite complex to analyze. And so in our experience, issuers have simply excluded the UK, particularly where they have found that there's sufficient demand for their token in other parts of the world. Because one of the challenges with this is not just the difficulty in analyzing it, but there has not yet been a market consensus as to how certain of these EU directives apply. Now, on the other, we've also mentioned Switzerland and Gibraltar. Switzerland, I just have my quote up that I like for Switzerland, where it says, the Swiss economic minister said that Switzerland wants to be the crypto nation. And we all would have heard of Zug as the crypto valley. Now, although they are very keen on supporting crypto, this doesn't mean that it is without regulation, because they too, FINMA, which is a Swiss regulator, has also issued some guidelines in relation to crypto. And Gibraltar is somewhere where, as far as we're aware, very open to crypto, and they were one of the first, or the first country to issue regulations for initial coin offerings, which is, going back to my point that early regulation is often a sign of support, because the fact that they were the first to issue regulations, is an indication of how they are wanting the industry to develop. It is, might sound counterintuitive that they are friendly, but they were the first to issue regulations, but that is really a sign of engagement in our view, and wanting to create an environment where people have sufficient clarity and certainty so that they know how to proceed. So that is a snapshot, like I said, 20,000 feet across the world, as to where the position is right now. John, over to you to tell us what you think will be on the regulators' radars as the crypto ecosystem evolves.
Great, thanks, Sophie. So this is our final slide, and it's really looking at where we think regulation is going to go. Everything that we've just been talking about has really been focused on security classification and these primary offerings. So an ICO, your initial offering. Actually, again, looking at this through the lens of the capital markets existing practices, there are a number of things happening in the crypto market at the moment which we think will be on the regulators. If they're not already on the regulators' attention, they will be. I think the first one is looking at pre-sale activity. It's become a very standard market approach with crypto that you'll have pre-sale investors coming in early. And that's absolutely fine. There's good reasons why you'd want investors to come in early to support the product, and then to obviously get some kind of benefit for coming in earlier. If you look at this from a traditional point of view, leading into an IPO, anyone that's going into an IPO is going to have quite strict requirements around what they can do in terms of pre-sale arrangements. Stock exchanges will not allow someone to come in really quickly just before the IPO to take a huge discount if it's not commensurate with the amount of risk that they're taking. It needs to be fully disclosed. In your IPO prospectus, you're going to have to say exactly what you've given to your pre-IPO investors, what the discounts are they connected parties, a lot of focus on what those pre-IPO arrangements are. Now, if you look at the crypto market at the moment, obviously none of that exists. People come in very quickly before an ICO. They may be connected parties, they might be significant discounts, and it may not even be disclosed. So when you start selling to the public and you haven't told the public that you've actually given huge discounts to friends and family or connected parties, that could be a potential issue. And again, this is not going to change the market. It's obviously something which is very part of the market at the moment, but actually it is something we think people, regulators will start looking at as this market matures. The other one is secondary market trading. Again, looking at traditional markets, insider information, market manipulation. Some very sophisticated laws, often criminal sanctions, around what individuals do with inside information, when abusing that information, profiting off that information. In the crypto world, in some situations, actually that type of activity is almost encouraged and expected. So you have a startup who says, we're paying these guys who like our product, we're paying them per publication on social media, or per article supporting our product on online somewhere. Those type of activities, are you disclosing that? Is the issuer actually explaining that they've paid someone to go and support the price and support the product? Things like the celebrity endorsements. Are the celebrities actually saying that they're getting paid to do this stuff? On the flip side, negative news, rumours, pushing down prices because you don't like a competitor. All that type of stuff is regulated in the real world. And if your token is a security, it is regulated today. So, and again, I think what we've started to see actually in the US, questions around the Bitcoin price and market manipulation, we again think that's going to be the next focus, the next wave of regulation is going to be around what's going on in the secondary market. One other point about that is the digital exchanges. there is now more focus already on digital exchanges, what tokens they trade, what processes they put in. Obviously, there have been a number of big incidences of fraud or hacking with the exchanges. What we've seen in the last 6 months, the exchanges have had to start asking for quite detailed legal opinions around token terms. So if you're an issuer, you want to list on most exchanges now, they will expect a legal opinion giving you the type of analysis that we were talking about earlier around Zilliqa to ensure that Zilliqa can be listed on that exchange. So that's something we've only seen in the last probably 6 months. So then in conclusion then, I just wanted to sort of go back to this essential point. It's like, why are we here? Why does this matter? Actually, from a regulator's point of view, this is a public fundraising. If you're going out and raising money from the public, there are standards that we expect. And when I say we, I mean everybody. Because everybody signs up to like shares, IPOs, bonds. There is a huge amount of regulation and thought around how that is regulated for society. And crypto is just the next form of that fundraising. So I think I'm sure there are people even in the room who will say, why are we here? We shouldn't be complicating things. Actually, this is just a form of fundraising. It's at its very, very early days, but it's going to develop, and we see it replacing some of those traditional shares and bonds. Maybe sort of 10, 20 years' time, bonds will be cleared through Clearstream, shares will all be digital. We are absolutely at the very start of that process. So I think then going back just quickly to principles, what do we look at from a capital market securities law point of view? Investor equality and fairness. If you're going out to the public, they need to know what you're selling. They need to know what you've dealt, and going to the pre-sale idea, that you need to tell them what you've done with your pre-sale activities so that they are buyer beware, they know what's going on. Retail investor protection. Regulators care when you sell to mums and dads. They care about retail. They're going to be all over issuers who are trying to sell to retail. In our world, you have to comply with the higher retail prospectus requirements. Again, if you're selling tokens to retail investors, you should expect a higher focus from regulators. And then the final one is on full disclosure. So the whole premise of public markets is that investors are given all material information to purchase. You don't have an interaction with the issuer. You're an independent investor, and so you need to rely on that offering circular or prospectus to understand everything that's relevant to that business to buy your bonds or shares. Same process applies here. And we would say even if you're not classed as a security, the best practice for an ICU issuer is to disclose what your business is, what your token terms are, and what your risk factors are, so that even if it does all blow up, when it ends up in a court, and these will end up in court, you can say, well, we disclosed all these risks fairly. They knew what the risks were, and therefore we should just go on our way. It's their risk, and they accepted it. So look, I think that's really it for me. I think those principles are the things that really sort of why we're interested in this market. We think long term. There's no question there's going to be a lot of bumps. There's going to be a lot of fraud, etc. But actually, this is we see capital markets moving. We see over time that this is going to move into the mainstream sales of bonds and shares, and what we do every day is going to be affected by blockchain and crypto. So the final point to the same idea. It's taken hundreds of years for us to develop under UK and US laws, securities laws. So legislation, courts, court decisions. The first cases in the US and UK are in the 1800s around insider trading, market manipulation. We're at day one here in crypto, and laws are going to take a really, really long time to catch up to these advancements. So with that, thank you. I think we're the only lawyers on the card today, so that will be it from us. And if it didn't make sense, we've got our token regulation guide out at the booth as well. So with that, we can take any questions.
Thank you. I have a question with regards to the AML KYC guidelines that the central bank chiefs, when they met in Argentina, I think in March, they thought that they should apply these standard guidelines to the crypto exchanges. And this was also mentioned in the BIS report that was issued last year. I was just wondering what you thought these AML KYC laws to the crypto exchanges.
Yeah, thank you. It's a very good question, and it's actually it's a really key issue for any issuer looking at this market, especially in the secondary market, because you just can't control you don't know who's sitting behind these addresses. You don't know who the individuals are that are buying the tokens. The way that we are dealing with KYC and AML at the front end is quite a vigorous KYC process through the ICO itself. In the early days, issuers were just putting up their platform and not going through any KYC. If they then have done no KYC, they can't satisfy AML laws. We've heard of issuers that have raised a lot of money in crypto. Banks won't touch that. Dirty crypto, they won't touch it if you can't verify where that's come from. So now you'll find most ICO issuers will have at least a primary process. They might pay a third-party provider to go through that KYC process on the primary. In the secondary, going back to the platform I was talking about earlier, that's the type of thing that they're also trying to deal with. One of the reasons they're putting that whitelist in place is their banks have said to them, you are a security. If you can't control who's holding your security, we may not be able to bank you. So you have to go down that path of what actually is quite onerous, saying if you want to buy this token, you need to go and verify through the website.
Am I ready? Hello, Dennis O'Neill. I just wanted to get a little idea of what the parameters or restrictions are if you do a registered token offering, and let's say you do it you register in Singapore. What countries does that allow you to be able to sell into? And if you register in the United States, what countries are you allowed to sell into, or are you mandated to register in each and every one of these countries? If you can give me a little idea of which countries, if you do register, give you the greatest, I guess, audience into multiple countries.
Yep, sure.
So this is what we were talking about a little bit earlier, in the sense that you need to do a two-stage analysis of where you're issued and where you're issuing into. There isn't a concept right now that if you register in one place, then that covers you everywhere else from a formality perspective. But from a substance perspective, if you have met the requirements of the US for a securities offering, then chances are you are going to meet the requirements elsewhere. I should point out the US requirements, for example, are extremely high. And so that's not going to be an easy task in itself, but assuming you do, all that work that you've done is not going to be to no avail, but you would need to engage with the other countries as well. It's not a situation where you kind of tick and say, this gives me an umbrella to offer everywhere. And I think the other thing to bear in mind is that if you are a utility token, then there's no, as we were saying earlier, there's no concept of registration. Say in Singapore, the MES says, well, you're not a security, it's got nothing to do with me. It's like going up to them and saying, I'm trading seashells. They're like, that's nice. But they don't accept a registration in respect of a utility token. It doesn't restrict you, but you need to see what the requirements are in that country that you want to offer into.
And just a general point on that actually is around like this idea of regulatory convergence, and we talk about that in the normal capital markets as well. Like even in traditional capital markets, why do we have different jurisdictions having very different rules around security regulation? So that's an issue that people are concerned about even before crypto came along. Crypto only accelerates that process. Why don't we have one law which all the governments around the world agree, if you're going to do a crypto issue properly, then this is the requirements. Are we 20, 30, 50 years away from actually getting to that position? Right now, the regulators can't even agree what this is. There's not even a question that they're coordinating around how to get there. So I think we're a long way away from having that idea of like a kind of global securities law. But yes, that's again, even putting crypto aside, we think that's eventually where we might get to.
Yeah, but even in the conventional cap markets, we're not even there yet for the conventional cap markets.
Yeah.
I think we can take one last question.
Thank you very much for presentation. I had a question, where you think security tokens can be listed for today? Which exchange has license for listed security tokens?
None in Singapore. We've heard anecdotally only, we haven't verified this, anecdotally only Gibraltar, which is why Gibraltar was on that side of the spectrum. But in Singapore, as John mentioned, and actually most other of the big exchanges, what we're seeing is that issuers are coming to us and to other law firms asking for a legal opinion that it is a utility token. And what we've heard anecdotally from our clients is that those exchanges are putting some restrictions on who they will accept the legal opinion from. So it has to be a law firm that has a minimum number of partners, that is ranked within certain recognized legal directories, because they too are managing their liability on this.
All right, thank you so much, John. Sophie. I think it was a really enlightening session, especially for some of us who are probably not only investors in this space, but as well as people who are actually planning to go and doing their token sales as well. Thank you so much.
Pleasure. And as John said, on our the Linklaters booth next door, we have our publication. So feel free to take a copy of that.